Let's practice equity amount, which has to be presented on the balance sheet calculation. Before we start, subscribe to our channel for more videos.
Here is the initial financial data. The company reports the following at year-end. Common stock, $1,050,000. Treasury stock, $120,000. Deferred taxes, $140,000. Retained earnings, $515,000.
Let's find, what total amount should the company report as stockholders' equity? Here you can see possible options for the answer. We need to analyze the given data and determine which items represent equity. First, of course, revise what is equity. Second, analyze each data item. And third, determine which of the given items do belong to equity.
Let's revise. What is equity? Equity is the residual interest in the assets of a company, after all liabilities are subtracted. In simple terms, equity represents what the owners truly own after the company pays off everything it owes to outsiders.
Now let's analyze each given item. Determine what is it, and whether it is a part of equity or not, and why. We start from common stock. Common stock is the legal capital issued to owners, shareholders, when the company sells shares. It is shown in paid-in, or in other words, contributed, capital. Why it's equity? First, it represents owners' residual interest in the company from capital, contributed at issuance. Second, there's no obligation to repay it like a liability. Third, owners get returns through dividends and appreciation, not guaranteed payments. Therefore, common stock is added to equity amount.
Now let's analyze treasury stock. It is the company's own shares, repurchased and held by the company. These shares are not retired. They are issued, but not outstanding. Important to note that treasury stock is a part of equity amount calculation. However, it decreases equity amount. This is because buying back shares returns capital to shareholders and reverses part of prior equity issuance. Treasury shares don't receive dividends or vote. Accounting standards require they to be shown as a deduction in equity, not as an asset. You can't own yourself and call it an asset. So, treasury stock is a part of equity, however its balance is deducted from equity amount.
Now let's analyze deferred taxes. Deferred taxes represent timing difference-related tax balances. They can be two types. Deferred tax liabilities. These are taxes the company will owe later. For example, accelerated depreciation, applied for tax purposes, versus straight-line depreciation, applied for accounting purposes. Deferred tax assets. These are taxes the company will save later. For example, expenses accruals, which will reduce taxes in the future. Deferred taxes are not included into equity, since they arise from temporary differences between accounting and tax rules. They represent either future obligations or future benefits with tax authorities. So, deferred taxes are not included into equity amount.
And last item from the given financial data is retained earnings. Retained earnings represent the cumulative net income the company has earned since inception, minus all dividends paid. and minus other direct equity adjustments that flow through retained earnings. For example, prior period error corrections. Retained earnings are included into equity because these are earnings kept in the business that belong to shareholders. The balance of retained earnings increases with profits and decreases with losses or dividends. It's not a claim by outsiders, so it's not a liability. Therefore, retained earnings are added to equity amount calculation.
We have analyzed all items. Now we can calculate equity amount. Common stock amount is added. Treasury stock amount is subtracted. Retained earnings amount is added. And we get equity amount to be presented on the balance sheet.
Now let's add amounts from the initial financial data and calculate equity amount. We get $1,445,000. So, from the given options, the correct answer is C.
Thank you for watching. Subscribe to our channel not to miss new videos.